Thank you for watching this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps financial advisors, money managers, and individual investors understand the trend direction and the current level of risk in the stock market, allowing you to make better asset allocation, investment, and risk management decisions, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, August 28th, 2020. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for. And I will leave a link to their site in the description box below this video. For the week, we were up 3.26% on the S&P 500, and we closed at 3508.01. That is, of course, another new all-time weekly closing high on the S&P 500. This first chart we're going to look at is a one-year weekly candlestick chart of the S&P 500. So each candlestick does represent 1 week of trading. And I have a lot of great information for you guys, so strap yourselves in. I think you're really going to like this. I have a lot of information to share with you. Now, the first thing I want to point out on this chart is the two horizontal blue lines, which are set at the support areas. There is some support at 3,200 on the S&P 500. The larger area of support, the more major area of support below where we are currently trading, is at 3,000, as you can see right here. Now, when we look at what's going on in the stock market, I mean, this rally has been just unbelievable. And keep in mind, as the stock market continues to go higher, that we are going higher on lower earnings than what we had during 2019. The earnings per share, per composite share on the S&P 500 for 2019 were just a hair over $162. Earnings per composite share on the S&P 500 for 2020 will probably come in somewhere between $120 and $132, okay? So let's use the high end of that range. Let's use $130, and we're just going to say that we're setting at S&P 3,500. Right now, we're technically just a few points above that, but let's just use 3,500 for easy math, and let's use the higher end of the range of earnings estimates for 2020. What this means is if the S&P 500 is trading at 3,500 and we have $130 of earnings per composite share, the price to earnings ratio is setting just under 27. It's 26.92. Okay. Now, a PE of 26.92 on the S&P 500 is one of the highest price to earnings ratios ever, and definitely one of the highest we've seen in many, many years. So just keep in mind that the valuations on the S&P 500 are quite stretched at this point based on historical measures. Also, we are seeing over the last 5 weeks, as you can see here with this trend line that I drew, and I drew it just below the peaks in the volume bars, right, what we're looking at here on the lower right-hand corner of the chart, we can see that the volume has been falling week after week after week as the stock market is going up. That sets up a negative divergence. Now, it doesn't mean that the market will fall, but also keep in mind that we've had 5 weeks where the market has been positive. And if you go back through history, you can have, more weeks, right? Here's 6 weeks right here. But generally after 4 or 5 weeks, you get a negative week, okay? So it's just inevitable that we're going to have a negative week in the stock market at some point, probably over the next couple of weeks. It's just statistical probabilities. You don't have positive weeks every single week. And especially when we add in the fact that we've got this falling volume, we're in what's traditionally the worst 3 months of the year, August, September, and October. It doesn't mean the market has to be negative during those 3 months collectively, but during one of those 3 months, you generally get some type of a pullback. And I'll show you even more evidence in the next chart of how overextended this market is in the short term. But before we leave this chart, let's point out the fact that if we pull back to the 3,000 level on the S&P 500, which is where the larger area of support is, that is a 500-point pullback, which is equivalent to 14.29%. Anything over 10% pullback is a correction. So if for whatever reason, right? If next week is the kind of the short-term top in the market, and if we pull back to the 3,000 level, based on where we're sitting right now, that would be over a 14% correction in the stock market. And if we only pull back to the 3,200 level, which would be a 300-point pullback based on a 3,500 level, right? So that drop down to 3,200 would represent a 300-point pullback. That is an 8.5% pullback in the stock market, even if all we did was pull back to the short-term support level, which is now at 3,200. So there's many data points here that would lead to the possibility of a pullback of some sort in the stock market over the next few weeks or so. The next chart that we're going to look at is a 3-year weekly candlestick chart of the S&P 500. And the orange line is the 40-week moving average, which of course is very equivalent to the 200-day moving average on a daily chart. The first thing I want to point out here is that the S&P 500 is trading more than 13% above where we closed at today for this week. We're trading at more than 13% above the 40-week moving average. Now, as you can see here, anytime you get really stretched like we are right now above this 40-week moving average, you generally have some type of a pullback towards or to right at the 40-week moving average. And you can see this time and time again. And if you look at a much longer term chart, you can go back 5, 10, 15, 20 years, whatever you want on the S&P 500. And you can see that it's just a matter of time, right? When you get this stretched above the 40-week moving average, you pull back at least to the 40, if not below, okay? So keep that in mind that it's inevitable, guys, that we're going to pull back to the 40-week moving average at some point in the future. None of us know exactly when that's going to be, but a pullback at this point to the 40-week moving average would be a pullback of over 11%, okay? So just keep that in mind that if we pull back just to the 40-week moving average, that again would be a correction. Again, anything more than 10% drawdown is a correction technically, right? Anything more than 20% is a bear market. So right now we're trading at more than 13% above the 40-week moving average. So if we just pull back to the 40, we would have a correction in the stock market, in the S&P 500. The other thing you can see on this chart is that I've overlaid a Fibonacci retracement on the correction that we had in Q4 of 18 and then the rebound that we had in the first part of 2019. And we can see here that we start the Fibonacci retracement at the bottom of the move, okay? So where we bottomed and started to go up, and then I stopped it at the very top of the move before we had a pullback. And what we can see here, I mean, these Fibonacci retracements, guys, it's just so cool how this works. It's just absolutely amazing how accurate this stuff is. But you can see that the pullback, the retracement that we had after this rebound, pulled back right to that 38.2% retracement of this entire move, okay? So that's how this stuff works. So we had the upward move after the downturn in Q4 of 18, we had the upward move, and then we pulled back right to that 38.2% retracement of the prior move. And that took us down to just below the 40-week moving average. So that got me to thinking about, what if, right? What if the move this week was the final part of this move? So as you can see here, and hopefully you're looking at this on a larger screen. If not, put this up on your computer at home, guys, so you can see this, because this is really cool and it's very valuable stuff. Now, we just looked at the fact that 3,000 represents the long-term, or at least the larger support area from where we're at, right? I mean, there's support below where we're at, 2,850, 2,800, things like that. But the more near-term, larger support, right? Some support at 3,200, the larger area of support is at 3,000. And we can also see here on this 40-week moving average that the 40-week is just below 3,100, okay? 3085.22 is where we closed on this 40-week moving average. So the point is that if we started to pull back from right here, right? If the market peaks based on where we closed today and we pull back 38.2% of this move that we've already had from the bottom of the market on March 23rd, that would take us down to just over 3,000. Hopefully you can see that where my cursor is circling. That would take us down to 3,005.36. is where we have this 38.2% retracement based on where I have the Fibonacci retracement scales set. So the point is 3,000 is close enough, all right? So I hope you're seeing that a pullback of 38.2% of this entire move that we just had here, okay, just like what we had here, that pullback would take us below the 40-week moving average and down right to that 3,000 support level. So it's just another data point that shows you that a pullback to somewhere around the 40-week moving average or slightly below and towards that 3,000 long-term support level or larger term support level as it is completely in the cards based on what we've seen. And the fact that we have seasonality going against us, right? The worst 3 months of the year are traditionally August, September, and October. That's another data point to keep in mind. The fact that we've had falling volume over the last 5 weeks on a rising stock market, that's another data point to consider. Also, again, we're just a couple of months away from what's probably going to be a very contentious presidential election. That's another data point to consider. And the fact that earnings on the S&P 500 are probably going to be at least 20 to 25% lower than what they were last year. So we have a rising stock market on falling earnings, which means the only thing that's driving the stock market up, besides the Fed liquidity, of course, right? But we have PE expansion. That's what's allowing. It's price to earnings ratio expansion is what's allowing this stock market to go higher. In other words, the value in the stock market is not, the market isn't as good of a value as what it was a year ago, okay? So just kind of keep all of this in mind. It doesn't mean that we will pull back to the 40 over the next couple of weeks. However, we definitely could, right? Over the next 2 to 4 weeks, I think it's completely possible. None of us knows exactly when this is going to happen or what the catalyst will be that will cause it. But we are long in the tooth here, guys, and make no mistake about it. Now, to prove this point, let's move on to the triple Qs, and let's take a look at the triple Qs. And, of course, the Nasdaq 100, the triple Q is the ETF that tracks the Nasdaq 100. And the Nasdaq 100 has really ran way above its 40-week moving average. And the stocks that are in the Nasdaq 100 have been largely responsible for this huge upward move that we have seen since March 23rd. And as we can see here, the triple Qs, the Nasdaq 100 is trading more than 28% above its 40-week moving average. And again, just like the S&P 500, when you get extended above the 40-week moving average on the triple Qs, you generally pull back towards or right at the 40 and sometimes go below it again like we did in Q4 of 18. So the fact that we're so extended on the Nasdaq 100, again, is another data point suggesting that it's not a matter of if, it's just a matter of when we get this type of a pullback. And I also want you to understand that if we get a pullback from where we're at right now, if we get a pullback anytime soon on the Nasdaq 100, on the triple Q to the 40-week moving average, that is over a 22% pullback to the 40-week moving average based on where we're trading right now. That means the triple Qs would technically be in a bear market. All they would have to do is pull back to their 40-week moving average. I mean, think about how crazy that is, right? They wouldn't even have to fall. The triple Qs, the Nasdaq 100, wouldn't even have to fall below its 40-week moving average, right? It would just have to pull back to the 40-week moving average, and we would be in a bear market on the Nasdaq 100. So it just shows you how lofty these valuations are. It just shows you how extended this stock market is at this point. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how Simple Market Signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and then we know that we hit the all-time high on February 19th at 33.8615. That is the closing high so far on the S&P 500. And then we had this intraday reversal on Thursday, which I talked about in my Simple Market Signals newsletter, which of course is how I disseminate the signals. And then we closed lower on Friday again. And so what we can see here is, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over, and that that things were changing. And so I gave people a heads up right here over the weekend, and I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, okay? And it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, all right? So that thing had been positive for, 5-6 months, and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are 3 powerful indicators. There's the Simple Market Signals proprietary risk level signal, There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market, and a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.